Most loan officers who leave their W-2 job and go off on their own make this mistake before they ever fund their first loan as a broker. They pick the wrong entry point, not the wrong lender, not the wrong niche, not the wrong market, but the wrong entrance into being a mortgage broker. The wrong structure and the one decision can cost you 12 to 24 months of momentum, time, income, energy, trying to undo it later. So if you're a loan officer and you're serious about thinking about opening your own mortgage company, I'm Megan, and in this video, I'm going to be going through with you 3 paths: what they cost you, what they actually pay, and which one is the right one for you to consider as you start to decide your next moves. And I'm going to tell you something that most people in this space aren't really willing to say out loud, because one of these paths does sound like the smartest, safest starting point, and it almost never is either of those two things. So let me give you a little bit of context on why I'm even talking about this. I've been in the mortgage industry for over 2 decades, and I'm not going to sugarcoat it. There was a learning curve when I opened my mortgage company. But the thing I'm most grateful for is the transitions I made when I owned the brokerage. They were so easy compared to when I worked somewhere else that wasn't my company. I didn't take those detours after making that mistake once. Since then, I've worked with loan officers across the country who are sitting exactly where you're sitting right now in, an employee seat, watching their company keep some of their margins that they've earned, wondering if there's a better way. Some of them went independent right out of the gate. Some of them started with a broker platform that they went into, and some of them have now come into our CoLAB model. I've watched all 3 play out and up close, and the patterns are consistent enough that I can tell you with confidence which path leads where. And here's the broader picture first. The mortgage brokers now are representing over 25% of the market, up from roughly 10% a decade ago. There are many of you switching. So let's really understand these paths. The first path, and the one that most loan officers are defaulting to because it's been the newer option, is joining a low cost or a profile broker platform. And here's how it works. The platform holds the broker company license. This is really important. They provide compliance oversight, some type of technology suite or a baseline, sometimes some processing options, and a recognized infrastructure. You operate under their license as a branch, and in exchange, you pay them a flat fee per file or a basis point split on each loan that you close. Now, why do most loan officers do this first? Because it feels like the safe on-ramp, because I see a lot of people do this, then go open. It feels safe, right? Lower upfront costs, someone else handles compliance. You get to test out being a broker before you commit to full ownership. I understand the logic, I really do. But here's what the logic is missing if you choose to go this path. A broker platform is not a step towards owning your brokerage at all. It is a separate destination entirely, but you do take on some owner-like characteristics. So you're taking on the stress, but without the reward. You build your entire operational infrastructure inside their ecosystem. You market the way that you want to market. Your lender relationships, usually most of them have most of the ones that you want to work with, but they are managed through someone. Your compliance infrastructure is theirs. Your brand is most likely tied to theirs in some way. Your processors, your LOS, your workflows, all of it lives inside their house, right? And then one day, maybe a year down the road, whenever that is, 2 years, you decide, okay, I'm ready. Like, this is not as hard as I thought it would be. I'm going to go independent. You want your own company license. You want to do your own thing, your own entity, your own lender relationships. And you realize once you start making the move, you have to start almost entirely over. They have been doing this for a long time. They have systems set up that they've never taught you. They've just taken care of it. Now you have to go apply for a company license. You have to reestablish lender relationships. You have to rebuild a tech stack. Go find a person to help you build a tech stack. You have to rebuild a pipeline, and while still trying to originate and generate income. That is a second transition. So now you've put yourself through 2 transitions in a very short period of time. And second transitions are brutal. And let's talk about the math here for a second. Per file platform fees typically run somewhere between, some of them as low as $500-$600 to $1,500. And then you have to also factor in the 10 to 20% admin fee for your payroll costs. And even if you're paid 1099, those same costs apply in self-employment taxes that you're going to then pay. At 3, 4, 5 loans a month, this adds up for infrastructure you don't own, for a license that isn't yours, for a brand that isn't building you any equity. As your production grows, you're writing bigger checks to someone else's business if you truly want to own one day. So comfortable is the enemy of ownership. And the per file model is very, very comfortable. I get that. It's great for somebody who knows without a doubt, I just want to collect my checks, but I don't want to own the building. Somebody can just take it from me after I've managed it for years. The second path is going fully independent. And I know this one sounds like a lot, and I know it's scary for a lot of people. So I want you to just sit and think about it, because I've watched loan officers build, this whole opening their brokerage thing up in their heads, convincing themselves it's either super expensive or that the costs are going to be too much, the time. And I'll be honest with you, for most experienced loan officers who are closing loans consistently, the costs that you pay for the licenses, the startup costs, it's one of probably the most affordable businesses you can open. So the costs are not that bad. The capital barrier is almost always lower than the fear barrier. So why don't as many people do it right out of the gates? And it's because DIY means exactly that. You're doing it yourself. And our industry doesn't really have a structure to help people do it. You're building the compliance infrastructure, you're vetting and setting up lenders, you're choosing your integrated technology, you're figuring out processing, you're running a business and originating loans at the same time. It is the time commitment, and time away from originating is very expensive. And that's the piece that people feel, but they don't always calculate. And that's what happens. For me, I didn't stop originating. I hired people. So I spent money to have somebody else handle it. Now, for the right loan officer, someone who is highly organized, has the bandwidth to build while they produce, and has access to employees or guidance, this path works. But that is very hard to find. And let's be honest, it's more responsibility than what you have right now as a W-2 employee. You have to train employees on how to do things that you don't know how to do yet. And this is where the third option starts becoming more and more attractive, and why we built it. Now, before I go into the third option, the upside of opening on your own, full ownership of your economics, there's no ceiling. You make the decisions. You don't have to check with anyone. Your comp, you negotiate. Your margins are yours. Your brand is yours. Your client relationships are legally yours. And when you build something, you are building something that actually builds value. It just may take you time to have value, because in my experience, everyone who is owned, from my experience opening my brokerages, it will take you a good 5 to 7 years to get into the swing of doing things correctly. You will do more wrong than right with the things you've never done before. And that's because you obtain and you do your own license. Even if you hire a licensing company, you pick the relationships you work with, right? You build that tech stack, you do all that stuff. But you just don't know how to do it when you're starting out. So you make mistakes like anything else. And when you own the business, those mistakes hit your pocket directly. And doing it yourself, when it works and markets are strong, it is extraordinarily rewarding. In the 21s and the 22s, whew. But for loan officers who are still learning what running a brokerage actually looks like, doing it entirely alone while trying to maintain production is where things go sideways fast, or when markets shift and you're not closing as much and you can't pay for the staff that you've brought on or the expenses that you have decided to carry. And this one, and that's why this third option I'm going to go through is one that I wish existed when I was making the transition, because I wasn't ready to own when I started owning. The third path is what we built at CoLAB. And I want to explain it very clearly, because it is genuinely very different than both models I just explained, and there's not anything like it in the marketplace. For the very reason I explained, we created a wish list as broker owners for other loan officers going to open their brokerages. So here's the core idea. You go directly into opening your own brokerage. You own your license, you own your LLC, your entity, but you do not build the infrastructure alone. You lean and use the infrastructure that we created over the last 10 years. And you do not do the work that makes you no money. When you come to CoLAB, you can start on our transition team while getting your company open, or you can stay at the company you're at while your company is getting open. And then our team helps you open your company. You're using similar technology, the same systems, the same operations team that I've trained for 10 years. You will use them but be completely independent, shared resources while being independent. There's no second transition. There's no starting over. What you learn and build on day one on the transition team or right as a broker owner is what you're running your business on when your license is approved with your state. And here's what makes this model fundamentally different from a platform. You own it 100% of the business. You own your license, you own your entity, you own your lender relationships, your client relationships. CoLAB is behind you, handling the operational tasks and responsibilities, the compliance support, the processing has options so that you can focus on what actually generates revenue, which is originating, marketing, and selling. Originating loans and building relationships is what most of us enjoy in this business. You hand off the work that makes you no money to people who are really good at it, who have been trained throughout the years and know the things to avoid and the risks that you don't want to take. You keep the work that does. So in terms of costs, because that's always a question, CoLAB charges a monthly fee that scales based on what you close. I always call it when you win, we win. So if our model helps you grow, you win and we win. I always feel like there has to be a win-win-win. It's a structure. It is structured to run lower the cost than profile models as your production grows. There is an upfront investment while we get your company open because we're doing real work to build a real business before you're ever open. It is a smarter path to the same destination. We've been calling it the third option. It's the way that you can get to being successful, not in 5 years or 6 years or 7 years, but in year one, you can start increasing your production. You can start making more money. Let me tell you about two of our loan officers who came through our CoLAB model in the last year, because their stories illustrate exactly who this model's built for. The first was Milo. Milo wasn't sure he wanted to open a brokerage when we met. He was not in a great place in the retail space. He had been in the broker space before. He knew he was done being W-2. He wanted to make more money, but full ownership felt like a really big leap for him. So we put him on the transition team and he got to see the systems, see what onboarding looked like, the infrastructure, learn the model, meet our team, make a decision without the pressure. By month 6, he was ready. He knew it. We knew it. Today, Milo operates his own brokerage with CoLAB behind him. He's grown his business 35% in 12 months since coming over and working beside CoLAB. He went from uncertain about ownership to building a team in 12 months. And it's been one of the most rewarding experiences to see him transform into the leader that he is and to be rewarded with the income and the recognition that he deserves. A second loan officer who came through our program is Nathan. Nathan lives in a state where getting a broker license takes up to 9 months, 10 months even. Nathan was looking at going over to a profile platform while we helped him get his company open. And as we talked about it, I really tried to paint the picture to him about multiple transitions. And having 2 full transitions, we laid out the math and we showed him what 2 transitions actually would cost him in doing so, in time, in dollars, in momentum. And he made the decision at the end of the day to come onto the transition team while we helped him get his brokerage open. Today, Nathan's open and he's in one of our live videos. You can go watch. He's running his business. And he said multiple times in that video, I don't think people understand. I'm making more than 2 times what I was making as a loan officer, more than 2 times. In the same market with the same clients, closing similar loans, his business has grown also, volume and unit wise. The difference was the path that he chose to get there. It made it easy. So let me put all 3 of these side by side so you can see this clearly. Profile platform. The license belongs to the company. The brand equity belongs to them. The tech and systems belong to them. The cost grows as your production grows. And if you ever want to go independent, you're starting over. This model's right for someone who genuinely does not want to own a brokerage. They feel like working somewhere, but having more autonomy to feel like it's their own thing. That's who it's for. Now, the DIY independent route, this license is yours from day one. The brand equity is yours. You build that equity, you build the tech, you build the systems, which takes a lot of time and it does take money. Long term, it's the lowest cost to start up, but long term, it costs you the most. And you go there directly, but you build it alone because there really aren't people to help. This model is right for highly organized bandwidth operators who have access to maybe some assistance from someone. The third option, our CoLAB model, the license is yours from day one. You have your own equity that you build. You can sell this business. The tech and the systems, they're built for you, so you don't have to take the time to do it, and they stay with you. The cost does scale with your production, that win-win I was talking about, and runs lower than a per file model. And you go directly into ownership if you decide to go on that transition team, but you don't have to worry about the infrastructure or the operations. This model's right for loan officers who value their time, don't want to get caught in non-money making activities, and they're okay not recreating the wheel. They don't feel like they have to figure out every piece of the puzzle. They want to own, you want to own your own destination, and this path will get you there the fastest. So here's where I want to leave you. If you know, like genuinely know, not just hope, that you one day want to own your own business, that you've built something that you want to be yours. If it's for your team one day, your family, your kids, or that you want to sell it, do not spend 12 to 24 months paying for an infrastructure that you will eventually leave and have to rebuild on your own or under something else. Go to the option directly, even if it's scary. Go there directly, build it once, build it right. The question's not whether the opportunity is real. It is real. It's just, are you ready to make that step in your life? The question is, which path gets you there with the least friction, the least wasted time, and the strongest foundation? If you're trying to figure out which of these paths makes the most sense for you, for your specific situation, your state, your volume, your timeline, your pipeline, that is exactly the type of conversations I have with people when they book a Zoom call with me. I do one-on-one strategy calls. I also do meet the team sessions twice a month. So if you're not just casually curious, but you're really serious about wanting to understand this is not a sales call. There is no script. There's no pressure. It is a real look at where you are, where you want to be, and what's going to help you get there. So this is what will help you start figuring out what actually makes sense for you. And sometimes that answer is CoLAB. Sometimes it's not. Either way, you leave with a clear picture. The link to book a call is down in the description, where it always is. It takes 90 seconds to schedule. The opportunity in the broker channel is real, and it's realer than it's ever been. Milo's proof, Nathan's proof, I'm proof. The only question is whether you're willing to plan. The only question is whether you're willing to plan it this seriously enough to do it the right way, so you get those rewards sooner than later. I will see you in the next video. And if this breakdown has helped you in any way making decisions about your career in the mortgage industry, make sure you subscribe to the channel. We issue new videos every week. No fluff, no hype, just conversations about what actually works and conversations about things that nobody else is talking about. I'll see you in the next one.